So, there is a number at the center of this story that I want you to hold in your head for the next 25 minutes. That number is $1 trillion. That is what American companies are spending this year alone building out AI infrastructure. Data centers, chips, power plants, cooling systems, fiber, the whole stack. $1 trillion. That is 3% of the entire US economy dedicated to a single technology. Now here's the question that nobody on Wall Street wants to answer out loud. What if the assumption holding up that trillion-dollar bet, the assumption that American AI companies will dominate the world because the world has no other choice, what if that assumption is wrong? Because something happened in June 2026 that should have been the biggest financial story of the year. Instead, most people missed it entirely. A Chinese AI model built by Z.ai was released in June. It's called GLM 5.2, and in its first full week after launch, daily token volume grew 27 times. The number of customers using it grew 80 times. 80 times in 1 week. American companies, not just startups, not just experimenting developers, but real companies paying real money, switched to a Chinese AI model at a rate never before recorded on any platform tracking model adoption. And the reason they switched is not complicated. It's not ideology, it's not politics, it's price. Chinese open source AI models are 60 to 90% cheaper than the equivalent models from OpenAI and Anthropic. 60 to 90%. And the performance gap, according to Stanford's 2026 AI Index, has collapsed from roughly 30 percentage points in early 2023 to just 2.7% today. 2.7%. That's the gap between the best American AI and the best Chinese AI. That's not a lead, that's a rounding error. So the question becomes, if the performance is nearly identical and the price is 90% lower, why would any rational company keep paying American prices? And if they stop, what happens to the trillion-dollar bet? That's what this video is about. With that said, let's get into it. I'm David Whitmore, Chief International Analyst at Global Insight News. Hope you're doing well. Come for the geopolitics. And stay for the trillion-dollar bubble that China didn't pop, but might be about to. Let me start by explaining what the AI bubble actually is. Because when people say bubble, they mean different things. And precision matters here. A bubble is not just a high stock price. A bubble is a high stock price built on an assumption that turns out to be false. In the dot-com bubble of 2000, the assumption was that every company with a website would be profitable. That was false. The Nasdaq dropped 80%. In the housing bubble of 2008, the assumption was that housing prices never fall. That was false. And you know what happened next. The assumption holding up the AI market today is this: American AI companies will generate trillions of dollars in profit because the world will be forced to use American technology, because there is no other option that is anywhere near as good. That assumption has a name. Analysts call it the AI monopoly thesis, and it is the foundation under Microsoft's stock price, Nvidia's stock price, Alphabet's stock price, Meta's stock price, the entire Magnificent Seven. Now hold on, because before I tell you why that assumption might be wrong, I need to give you the other side, because it deserves to be stated fairly. The bulls have a real case. American AI companies still lead on the most advanced models. They have the deepest talent pools. They have the most compute infrastructure. They have the most enterprise relationships. And the most advanced AI, the kind that will run autonomous agents, that will run complex reasoning tasks, that will eventually approach artificial general intelligence, that is still, for now, made in America. That's the bull case, and it's not nothing. But here's the catch. The bull case depends on continued dominance, and dominance requires a gap. And the gap, according to every piece of data published in 2026, is closing fast in a way that is structurally hard to stop. Let me walk you through the 3 problems at the heart of this story. Problem 1, the business model is broken in a way the market hasn't priced in yet. Here's how software is supposed to make money. You build the product once. Every new customer is essentially free money. Costs stay roughly flat. Revenue grows. The gap between those two lines is called margin. And margin is why tech stocks became the most valuable in human history. AI broke that model because every single time you ask ChatGPT a question, it costs OpenAI money. The chips generate heat, they wear down, the electricity bill increases. Every query served is a real-world expense. More customers does not mean more profit. More customers means more cost, dollar for dollar. That's not a software business, that's a restaurant. Except it's a restaurant that loses money on every meal it serves, and its plan to fix the problem is to serve more meals. Now let me give you the numbers, because this is where it gets genuinely alarming. OpenAI generated $20 billion in revenue in 2025. $20 billion, the fastest revenue growth in tech history. And they lost $14 billion in the same year, net. After all that revenue, $14 billion gone. Internal forecasts project cumulative losses hitting $44 billion by 2028. But here's what makes this even more concerning. The company's own CFO warned executives in April 2026 that OpenAI might struggle to finance upcoming computing deals if revenue growth slows. The CFO of a company valued at over $1 trillion, warning that they might struggle to pay the bills. And it's not just OpenAI. Anthropic, the company behind Claude, reached $4.3 billion in annualized revenue in April 2026, against $19 billion in total costs. They spend $3 to make $1, and they are not expected to stop burning cash until 2027. Together, OpenAI and Anthropic have committed $1.05 trillion in cloud spending to Microsoft, Oracle, Google, and Amazon. Together, those commitments make up between 43 and 54% of each provider's entire future revenue backlog. Let me put that in plain English. The entire future revenue of Microsoft's cloud division, the backlog, the committed contracts, the money they've been promised, nearly half of it depends on two companies that are currently losing billions of dollars every quarter. That is not a diversified revenue stream. That is a concentration risk of historic proportions. And the Nasdaq-Shiller CAPE ratio, a measure of how expensive stocks are relative to earnings, exceeded 40 at the end of 2025. That level has only been reached once before in recorded history, right before the dot-com crash. Problem 2, the customers are not getting what they were promised. A National Bureau of Economic Research study published in February 2026 found something remarkable. 90% of firms reported no measurable impact from AI on workplace productivity. 90%. An MIT study found that 95% of organizations investing in generative AI were receiving zero return on their investment. A separate analysis found that only approximately 3% of people pay for AI services. Now, these numbers exist alongside real and genuine productivity gains that some companies are absolutely seeing. AI coding tools are real. AI customer service automation is real. AI document processing is real. I'm not saying none of it works, but I am saying this. The story the market is pricing in is not AI is useful for some things. The story the market is pricing in is AI will transform every business and generate trillions in profit within the decade. And the evidence from the actual companies actually using these tools does not support the trillion-dollar version of that story. McKinsey's 2025 State of AI survey found that only a minority of companies reported AI meaningfully increased revenue or reduced costs. Enterprise generative AI spending grew from $1.7 billion in 2023 to $37 billion in 2025. And most chief information officers still describe their AI initiatives as pilots, without clear ROI metrics. Pilots, 2 years into $1 trillion build-out. That gap between what is being spent and what is being returned is the crack in the foundation. And it has a name in the financial world. It's called a productivity paradox. You spend massively on a new technology, productivity doesn't move, and eventually investors start asking questions. Now let's talk about problem 3, because this is the one that makes the first 2 problems potentially fatal. Problem 3 is China. And I want to be clear about what China represents here, because it's not the story you're being told. The story you're being told is that China is trying to steal American AI secrets, that China is a threat to be contained, that export controls on chips will slow them down. That story is not false, but it is dangerously incomplete. Because here is what the data shows. In January 2025, a Chinese company called DeepSeek released a model that claimed near industry-leading performance, trained for less than $6 million. $6 million. OpenAI spent an estimated $78 million training ChatGPT 4o. DeepSeek produced a comparable result for less than 1/12 of that cost. When that number became public, NVIDIA's stock dropped 17% in a single day. $600 billion in market value, gone in one trading session. Now, some people said that was an overreaction, that DeepSeek's numbers weren't accurate, that American models were still better, and they were right at the time. But here is what happened in the 18 months since. The performance gap between the best American and Chinese AI models, according to Stanford's 2026 AI Index, collapsed from 17 to 31 percentage points in early 2023 to just 2.7% today. In some benchmarks, Chinese and American models have traded the top spot multiple times. In April 2026, DeepSeek released its V4 model, built in partnership with Huawei, not NVIDIA, on Chinese chips, and it beats all rival open models on math and coding benchmarks, trailing only Google's flagship model on general knowledge. The export controls on American chips didn't slow China down. They pushed China to innovate on their own hardware. And then, in June 2026, GLM 5.2, built by Z.AI, landed within a percentage point of Anthropic's best model on one closely watched benchmark, at roughly 1/5 of the cost. 1/5 of the cost. And the adoption numbers from Versal, one of the largest platforms for developers deploying AI-powered applications, show that GLM 5.2 saw the fastest adoption of any model tracked in all of 2026. In its first full week, daily token volume grew 27 times. Number of customers grew 80 times. Now hold on, let me give you the number that really matters. The share of tokens used by US companies on Chinese AI models through OpenRouter, the platform that tracks this, sat above 30% every single week since February 2026. It has gone as high as 46%. The average for the previous 12 months was 11%. Before that, 4.5%. In the space of 1 year, the share of American AI workloads running on Chinese models went from 4.5% to as high as 46%. That is not a trend, that is a collapse in the American AI monopoly thesis happening in real time. And the companies switching are not ideologically motivated. One AI startup called Lindy moved 100% of its traffic from Anthropic's Claude models to DeepSeek in June 2026. The CEO said, and I'm quoting, "You could see that cost curve go down, like crash to the ground." He said the decision will save the company millions of dollars within months. Price is doing the work here, said the head of agentic infrastructure at Versal. When a task doesn't need the best model, teams are beginning to route it to the cheapest one that's good enough. And the recent wave of models coming out of China is winning that trade. Now, I want to explain something that most coverage of this misses. The export controls, the effort to deny China access to the most advanced American chips, did not fail because they were poorly designed. They failed because of how innovation actually works. When you cannot get the best chips, you are forced to figure out how to do more with the chips you have. You are forced to innovate on efficiency, and that efficiency, once discovered, doesn't stay in China. China publishes open weight models. That means anyone in the world can download them, run them locally, customize them, improve them. The champion of open markets, the United States, reached for state control over who may touch a private technology. The government, most known for centralized control, China, is handing its most powerful technology to the world for free. That is the paradox at the center of the story, and it has commercial consequences that Wall Street has not fully processed yet. Because if Chinese AI is free, or nearly free, and Chinese AI is nearly as good, then the trillion-dollar American AI build-out is not competing against a country. It is competing against a price point, and you cannot recover $1 trillion selling something your competitor gives away at 90% of the quality for 10% of the price. So when does the bubble pop? And what does it look like when it does? Here is the honest answer. Nobody knows, including me. And I want to be careful here, because saying the bubble will pop is easy, saying when is much harder. And people have been wrong about this for years. But there are signals worth watching. Signal 1, what the bond market is doing. The bond market doesn't run on stories, it runs on math. Bond investors ask one question: will I get paid? When they get nervous, they demand higher interest rates. And when they demand higher interest rates, credit tightens, debt becomes more expensive, and companies running on borrowed money start to struggle. Right now, credit spreads, the premium investors demand to hold corporate bonds instead of government bonds, are near the lowest in recorded history, 2.6%. Tight, calm. The bear case says that's exactly what the spreads looked like in early 2007, before Lehman, before the crisis. Credit markets were completely calm while the housing market was already rotting underneath. Signal 2, capital expenditure pullbacks. During the dot-com bubble, the Nasdaq peaked in March 2000, but companies kept spending on fiber optic infrastructure well into 2001, a full year after the market collapsed. The market didn't wait for spending to stop. The market changed when investors stopped believing the story. Watch for the first major tech company that cuts its AI spending and gets rewarded by Wall Street for doing it. Because the moment the first hyperscaler pulls back on CapEx and investors celebrate it, every other CEO gets permission to do the same. Goldman Sachs analysts have reportedly said that the first hyperscaler to cut AI spending will be rewarded by the markets. When that happens, that's the starting gun. Signal 3, the IPOs, OpenAI has filed its S1 confidentially, working toward a listing as early as late 2026 at a valuation above $1 trillion, projecting a $14 billion loss for the year. With profitability not expected before 2029 or 2030, that IPO will be the single most consequential data point in the AI story, because it will force public market investors to look at the actual numbers, not the narrative, the numbers. And the numbers say OpenAI burned the equivalent of 70% of its revenue in losses last year. Its losses are projected to double in 2026. The question is whether public market investors believe those numbers will eventually resolve into profit, or whether they represent a structural economics problem that cannot be solved by waiting. Signal 4, the token price index. There is a metric called the Silicon Data LLM, Token Expenditure Index. It tracks the price that companies pay for AI tokens, the basic unit of AI usage. That index is down nearly 20% from its high. In the middle of the biggest AI build-out in history, the price of AI itself is going down. Why? Either demand is shifting to cheaper models, which means Chinese models, or buyers simply aren't willing to pay what American AI labs need to charge to be profitable. Either way, that is a bad signal for the trillion-dollar bet. Let me now give you the fairest summary I can of where things actually stand. The AI revolution is real. That's not in question. AI coding tools genuinely accelerate software development. AI customer service genuinely reduces costs. AI document processing genuinely saves time. These are not hype. They are happening. The question is not whether AI is useful. The question is whether the current valuation of AI companies, the trillion-dollar bets, the multi-trillion-dollar data center build-outs, is justified by the actual economics of the business. And the evidence in 2026 suggests a disconnect. OpenAI generates $20 billion in revenue and loses $14 billion. Anthropic generates $30 billion in annualized revenue and spends $57 billion. Together, they have committed over $1 trillion in cloud spending to support a business where costs go up linearly with revenue, and the performance gap with cheap Chinese alternatives is now 2.7%. Meanwhile, 90% of firms report no measurable impact on productivity. Enterprise AI initiatives are still described as pilots, and the share of American AI workloads being routed to Chinese models has gone from 4.5% to 46% in 1 year. Now, I'm not saying the bubble pops tomorrow. I'm not saying sell everything. I'm not a financial advisor, and this is not financial advice. But I am saying this. The story holding up a multi-trillion-dollar market is a story about American monopoly on a technology that is becoming increasingly commoditized by a competitor that is giving it away for free. That story has a shelf life, and the data suggests that shelf life is shorter than the market currently believes. Follow the price. It rarely lies, so let me bring this back to you. If you have a 401k, if you have index funds, if you own any broad market ETF, you own this story because the Magnificent Seven companies driving the AI build-out represent roughly 30 to 35% of the S&P 500's total market weight. That means when this story adjusts, and all stories eventually adjust to meet reality, it will not be contained to tech stocks. It will ripple. I'm not predicting a crash. I'm not predicting a collapse. Smart investors have been calling this bubble for 3 years, and the market has kept going up. It could keep going up for longer. But what I am saying is this. The signals are worth watching. The economics are worth understanding. And the China story, the one where a country produces nearly equivalent AI for a fraction of the cost and gives it away for free, that story is not slowing down. It is accelerating. That's the analysis for today. I want to hear what you think. Do you believe the AI bubble will pop? And if so, what do you think triggers it first? The bond market, the IPOs, a CapEx pullback, or something we haven't thought of yet? Drop your analysis in the comments. I read every single one, and the most thoughtful takes get a reply from me directly. If this gave you something the financial headlines didn't, share it. Share it with someone who has a 401k and doesn't understand what's inside it. Because understanding the story behind your own investments is not optional right now. If you're not subscribed to Global Insight News, this is the moment. Hit subscribe, turn on notifications, because this story is moving fast. The IPOs are coming. The CapEx decisions are coming. The bond market signals are developing in real time. And we will be here to decode every one of them with the same commitment to facts, the same independence, and the same refusal to tell you what the market wants you to believe. We tell you what the numbers actually say. That's what we do here. Until the next edition, stay analytical, stay skeptical, and remember, the $1 trillion is real. The question is whether the return is. I'll see you in the next edition.